$86 to $70 in 48 hours. If you were holding silver on December 28th, you just watched 17% of your position evaporate. And if you're wondering whether this was a natural correction, I need to tell you something. This was engineered liquidation. I'm Marcus Caldwell, and I've been tracking precious metals markets for over 15 years. What happened in the final days of 2025 wasn't just volatility. It was a systematic flush of leveraged positions that follows a pattern we've seen twice before. In 1980 with the Hunt brothers, in 2011 when silver hit $49, and now in 2025 the playbook ran again. But here's what most analysts are missing. The physical market completely ignored the paper crash, and that divergence tells you everything you need to know about what comes next. Let me walk you through the mechanics of what actually happened, because once you understand the structure, you'll see why this crash was inevitable, and why the next move could be even more violent. December 28th, silver futures hit 86.62. Social media erupted. Analysts were calling for $100, $150, even $200. The euphoria was maximum sentiment. And that's exactly when the Chicago Mercantile Exchange made their move. They announced a margin hike, 13.6% increase, effective immediately, during holiday week, when institutional desks were running skeleton crews and liquidity was already thin. If you were trading silver futures on leverage, you had one choice: post an additional $3,000 per contract within hours, or watch your position get automatically liquidated by the exchange. Most traders didn't have the cash sitting ready. The system started closing positions. Thousands of sell orders hit a low liquidity market simultaneously. 86 became 84, then 80, then 75. The cascade accelerated as stop losses triggered across the board. By December 30th, silver touched $70.05, a $16 collapse in less than 2 full trading days. Now here's where it gets interesting. While paper silver was crashing on the COMEX, I was watching dealer websites. Physical silver wasn't trading at $70. American Eagles were still priced at $76, $78, sometimes $80 depending on the dealer. Before I show you what this divergence means, if this analysis is giving you insights you're not getting elsewhere, subscribe and hit notifications. This channel exists to decode market movements that institutional players don't want retail investors to understand. Your subscription supports independent financial intelligence. Now let me show you the data that changes everything about this crash. The premium structure stayed elevated. Dealer inventories were depleting, not building. If this was a genuine demand collapse, you'd see physical sellers flooding the market. Coin shops would be packed with people liquidating their holdings. But that's not what happened. Buyers stepped in immediately. Industrial users saw $70 and hit the buy button. Solar manufacturers, electric vehicle companies, electronics producers. These aren't speculators. They're securing inventory for production lines. And when they saw a 14% flash discount, they bought everything available. This matters because silver has been in a structural supply deficit for 5 consecutive years. Global demand exceeds mine supply by 200 to 300 million ounces annually. You can't just activate new silver mines overnight. Development takes 5 to 10 years from discovery to production. Meanwhile, demand is accelerating. Solar panels require silver. EV electronics require silver. AI data centers require silver. These are infrastructure build-outs funded by trillions in government spending globally. The supply side cannot respond fast enough to price signals. Then on January 1st, 2026, China implemented new export licensing for silver. This is massive. China controls substantial refined silver supply. They're now restricting exports to prioritize domestic solar and EV manufacturing. Hundreds of millions of ounces just left the global market. Shanghai silver prices traded at a premium to London and New York during the crash. Chinese buyers didn't panic. They increased purchases. Physical dislocation was happening in real time while paper prices collapsed. This tells you everything about actual supply and demand versus futures market manipulation. Let me explain why the crash was so violent. The silver market was loaded with speculative leverage. Futures traders were using 10 times, 20 times, sometimes 50 times leverage, $1,000 controlling $50,000 of silver exposure. When prices rise, leverage feels incredible. Massive percentage returns on small capital. But when prices reverse, leverage destroys accounts in hours. A 10% drop with 50 times leverage doesn't reduce your position. It wipes out your entire account and triggers margin calls you can't meet. The CME saw this building. Open interest was exploding. Leverage was accumulating dangerously in the system. They pulled the trigger. Was it to protect market integrity or to protect banks with massive short positions facing catastrophic losses if the rally continued? We don't have internal CME documents, but we have pattern recognition. In 1980, exchanges changed rules mid-game to stop the Hunt brothers. In 2011, margins were raised 5 times in 8 days. Silver crashed from $49 to $26. The pattern repeats. Here's what most people misunderstand about volatility. Volatility isn't the enemy of a bull market. Volatility is the purification mechanism. It removes weak hands, it liquidates gamblers, it tests conviction. If you want silver to move from $30 to $100, it won't be linear. It will shake you out repeatedly. Markets don't reward everyone. They reward those who can handle psychological pain. If you sold at 70 because you couldn't stomach the move, you paid tuition to the market. After the crash, silver bounced 70 to 76 in 24 hours, 8% recovery in a single session. Then consolidation around 72 to 75 for 48 hours. As I'm recording this, we're trading around 71 to 72. Let me give you perspective. Even after the crash, silver is still up 140% from January 2025. If you bought at $30 and held through the entire rally and crash, you're still massively profitable. The crash didn't end the bull market. It cleared out tourists and reset the leverage structure. Technical analysts are watching the $70 level closely. If it holds, the next move targets $80 and a retest of 86. If it breaks, we could see 60 or even 55. But fundamentals haven't changed. Supply deficit persists. China restrictions are active. Industrial demand remains strong. The Federal Reserve is expected to cut rates in 2026. Lower rates make non-yielding assets like silver more attractive in portfolio allocation. So what are the realistic scenarios from here? Scenario 1. Silver consolidates between 70 and 80 for several weeks, builds a base, then breaks out to new highs in Q1 2026. Bullish analysts are targeting 100 to 120 by mid-year. This requires sustained industrial demand and continued Chinese restrictions. Scenario 2. Silver chops in this range and frustrates traders. Speculative interest fades. Price drifts lower to 60 or 65. Stays there for months, while fundamentals slowly catch up. This is the consolidation case where paper market dominates short-term price action. Scenario 3. Something breaks. A major bank fails to meet obligations. A government announces strategic silver reserve purchases. China accelerates export restrictions beyond current levels. Any of these triggers another violent move in either direction. I'm watching 3 key indicators right now. First, the gold to silver ratio, currently around 57 to 1. Historically, when silver is in a bull market, this compresses to 40 to 1 or even 30 to 1. If that happens, silver is outperforming gold on industrial demand, overwhelming the market. Second, Shanghai premiums. If Chinese buyers keep bidding physical silver above paper prices, that signals paper market losing credibility. Third, mining stocks. Silver miners have been underperforming the metal itself. Normally, miners leverage the commodity price and move faster. If miners start catching up, that confirms smart money believes this bull market is real. Let me address the $200 predictions. Robert Kiyosaki and others are calling for silver at 200 by end of 2026. Is it possible? Technically, yes. If China completely shuts exports, if a major bank defaults on contracts, if paper and physical markets decouple. But is it probable? That requires a perfect storm. You need panic. Loss of faith in financial system. Rush into hard assets. Could it happen? Absolutely. Should you bet your entire portfolio on it? Probably not. Risk management matters more than maximum upside scenarios. Here's my take. Silver is going higher long term. Fundamentals support it. But the path will be violent. We just saw $16 down in 48 hours. We could easily see another $20 drop before the next leg up, or a $30 spike in a week. That's the nature of this market. If you can't handle that volatility, you shouldn't be in silver. But if you understand the risk, if you're not using leverage, if you're thinking in years, not days, silver is one of the most compelling asymmetric opportunities available. Let me give you an action checklist based on current market structure. 1. Check your leverage exposure. If you're trading on margin, reduce position size immediately. Volatility is too high for full leverage. 2. Define your exit plan. Don't sell in panic, but don't hold forever without targets. Know your profit-taking levels in advance. 3. Watch the $70 level. If it breaks, reassess your thesis. If it holds, stay patient and let the base build. 4. Understand paper versus physical. Futures and ETFs are not the same as holding bars and coins. Counterparty risk is real in paper silver. 5. Ignore social media noise. Everyone has an opinion. No one knows what happens next with certainty. Make decisions based on your own research and risk tolerance. This is your capital, your responsibility. The crash from 86 to 70 was brutal. It shook out weak hands and reminded everyone that silver is high risk, high reward. But for those who understand fundamentals, who can stomach volatility, who are playing the long game, this crash was a reset opportunity. It cleared leverage from the system. It created a buying opportunity at a discount. It set the stage for the next major move. The bull market in silver isn't over. It's evolving. Fundamentals are stronger than ever. Supply deficit is real. Industrial demand is real. Geopolitical risks are accelerating. And paper market manipulation, while real, won't last forever. At some point, physical market will decouple from paper pricing. At some point, price will be set by actual supply and demand, not by algorithms and margin calls. When that happens, when real price discovery begins, that's when massive moves occur. We're watching history unfold in real time. The silver market is at an inflection point. What happens in the next few weeks could determine trajectory for the next decade. Stay sharp, stay informed. Most importantly, stay rational. This isn't the time for emotion. This is the time for strategy. The crash was the shakeout. The next move is the opportunity. Position yourself correctly right now. And 5 years from now, you'll realize this was the moment that changed everything.